start with today's section, which is to understand and brush up our knowledge on TDS and TCS provisions on foreign remittances. As you all know that in order to decide the chargeability of an income under the provisions of Income Tax Act, first of all, it has to get covered by the relevant provisions of the Act. For the purpose of determining or for the purpose of deciding that a particular withholding can happen, the charging has been provided under Section 4(2) of the Income Tax Act, which says that in respect of income chargeable under subsection 1, income tax shall be deducted at source or paid in advance, or where it is so deductible or payable under any provisions of this Act. So if someone is wondering that from where the provisions of TDS and TCS are coming, then one may refer to Section 4 of the Income Tax Act. In my personal understanding, apart from Section 2 and to an extent Section 6, generally the initial sections of Income Tax Act are not being taken into consideration by people at large, because they are, although being very literal in nature in terms of understanding, but they play a very important part in deciding whether a particular sum would be chargeable to tax or not. And
Anuj.
also, yes, Sridhar?
Yeah, I would like to pause you for a moment. So if you can go to your audio, the mic, the arrow, and there is a audio profile, background noise suppression. You can put it on auto so that the noise that is coming will reduce a little bit.
Is there some noise coming from background? Is it so?
So it is echoing. It is because either your speaker is on, you reduce your speaker volume.
Okay, sure.
Yeah. So people are getting the voice is not clear. Yeah. So if you can.
Now is it fine?
I feel it's better. But see, just check this audio once, the background noise suppression part, if it can increase the quality.
So I have in audio profile I have noise removal stated, and background noise suppression high. I have kept it high.
Okay, you
Now
put
is it
it on
better?
auto. Yeah, it is much better now. We can continue. Sorry for interruption.
No worries. Good of you to do so. Now I can continue with the presentation, right?
Yes, you can.
Sir, if you can make it full screen presentation, please.
Give me a moment. Okay, so
Yes.
I'll just proceed once again. So as I was saying about the withholding of tax and its applicability is prescribed under Section 4, subsection 2 of the Income Tax Act. The provisions of TDS and TCS are prescribed under Chapter 17 of the Income Tax Act, which heads as collection and recovery of tax. So it is the chapter under which the relevant provisions of Section 194 onwards are given, which contains the transactions which a person is required to deduct when making payment to a resident or a non-resident. As far as the rates and everything are concerned, under certain sections of this chapter, the rates are prescribed. But as we go ahead, we would know that under Section 195, the rates are not prescribed. And how to take it further, we will just understand during the course of presentation. Apart from the charging provisions and the procedural aspect, the compliance related provisions are also mentioned under the same chapter, which talks about which form is to be filed, when is to be filed, what are the prescribed formats under which one is required to report to the government in reference to the intimation about taxation being withheld from the source and deposited with government. So again, going a little bit back with reference to why this has come, because the government is aware that the population of this country is pretty wide. and it is nearly administratively impossible for them to just knock each and every door to and ask them to calculate their taxes. As we all know that almost 5 to 6% of the total population is right now filing the income tax return with on the income tax portal, and majority of those returns are either with nil tax liability or very low tax liability. So the government is also very much vigilant about how to collect the taxes which is actually due on a particular income received by a person as per the provisions of the Income Tax Act. That's why the onus has been given on the source so far as TDS provision is concerned, as it is rightly stated, tax deducted at source. So just giving you an example that a company is having 5,000 employees under its ambit. Now, if government wants to check whether they want to collect information from 5,000 employees and decide their accuracy, it would be very difficult for them administratively. Instead, what they have done is they have put the onus on the company itself to determine the tax liability as per section 192 of the Act, and accordingly the TDS is calculated by a company, deposited with the government, and information is provided to income tax department. What happens because of this is that from one source the government is obtaining information for 5,000 employees in this given example. So that is the basic purpose of tax deducted at source, and tax collected at source also works in some proportion with reference to certain specific transactions. With reference to foreign remittance and TCS thereon, we would discuss the same in the forthcoming slides. So in today's session, I will try and cover what is the section 195, what is the scope of 195 subsection 1, what is chargeability of tax in India, with reference to non-resident, how section 9 works, what is rates in force, what is procedure to be taken care of with reference to TDS and foreign remittance. I'm sure most of my fellow participants would have understanding on it. My job is just to give you the brush up or the clarity idea on how the procedure is being followed in the today's scenario. What is the importance of residency certificate? What is the use of double tax avoidance agreement, and how to read the same with multi. What are other sections under the Income Tax Act where the foreign remittance is being covered, TCS on foreign remittance, and some common issues which I have identified, which we can discuss along with question and answer session. So this is basically the overview of section 195. Section 195 starts with its scope and conditions of applicability. Subsection 2 talks about if a payer wishes to decide that the TDS applicability is lower than what is prescribed under the Act, then what action he can take. Similarly, 195 subsection 3, I beg your pardon, provides the mechanism in hands of payee with the same reference. What is the validity of certificate is given under subsection 4. With reference to subsection 5, 6, and 7, it grants the powers to CBDT with reference to making rules for section 195(3), with reference to forms which one can use for applying for nil or lower TDS as prescribed under section 195(2) and 3. And subsection 7 also grants CBDT powers to specify class of person or cases where recipient is non-resident, who will be mandated to furnish application to AO for determination of withholding. Section 195A talks about grossing up of tax. We will take in the upcoming slide. So for everyone's ready reference, I have just placed on record the subsection 1's direct. What it says is, let's read simultaneously. Any person responsible for paying to a non-resident, not being a company, or to a foreign company, any interest, not being interest referred to in section 194 LB or section 194 LC or section 194 LD, or any sum chargeable under the provisions of this Act, not being income chargeable under the head salaries, shall at the time of credit of such income to the account of pay or at the time of payment thereof in cash or by way of issue of check or draft or any other mode, whichever is earlier, deduct income tax thereof at the rates in force. Now, the entire scope and applicability is covered by this whole wordings. What it says, any person responsible for paying to a non-resident. So any person, when they mention, when we see the definition of person, it includes a list from individual, HUF, corporate, non-corporate, all sorts of entities. It also even does not bifurcate between the status, residential status of payer. So a resident as well as non-resident who is responsible for making payment to a non-resident is covered in the category of a payer as per the section 195 of this act. Who can be the payee? So payee, what it says, a non-resident not being a company or a foreign company. So by putting not being a company and then separately defining a company, in my understanding, all the non-residents of all categories are being covered under the spectrum of pay. What would be the amount payable? So in this coverage of section 195, almost every transaction is getting covered except for certain specific exclusions provided therein. What would that be? So interest, which is generally getting covered under section 195. However, when the provisions of section 194 LB, LC or LD are being applicable, such interest would be governed by such specific section and not 195. It says that not being income chargeable under the head salaries. So salary being paid to a non-resident would not get governed by section provisions of section 195 of the act. Okay. Apart from that, all the transactions, such as if you say payment of interest which is not covered here, rent payment, payment towards fees for technical services, royalty, payment for dividend distribution, everything would get covered. If the payee is a non-resident, then such payment would get covered under section 195 of the Income Tax Act. What is the time of deduction? It is generally amongst all the provisions of TDS, it says that payment or credit, whichever is earlier, barring few exceptions under every section of chapter 17 with reference to TDS. This is a common timeline which has been prescribed. So it is either on payment or credit to the account of a person, whichever is earlier, the provisions of TDS would get attracted. What is the rate of deduction? Now this is very interesting. So unlike the regular provisions where payment is being made to a resident, where the TDS rates are duly specified. If I take the example of 194C, the TDS rate of 2% and 1% is duly specified. In this provision of section 195, however, it has been so mentioned that the tax would be deducted at rates in force. That we will check in a little bit. So first of all, and foremost, and the most important portion of this entire seminar, I would say, is the scope again. So what the scope says, let's go back a little bit. It says that any other sum chargeable under the provisions of this act. Now I am putting a good emphasis on any other sum chargeable under the provisions of this act, because unless and until the payment in question to a non-resident is chargeable to the provisions of this act, the payment would not get subjected to TDS payment. So it is very much essential to determine whether a particular payment is chargeable to tax in India or not. Okay, now in this regard, I would like to draw your reference to section 5 of the Income Tax Act. Section 5 of the Income Tax Act specifically talks in reference to a non-resident that what is the scope of income in hands of the residents so far as provisions of Income Tax Act are concerned. So it says that any income which is received or deemed to be received, as well as accrues or arise or deemed to accrue or arise in India, shall be considered as income chargeable to tax in India. So before trying to apply the provisions of TDS, it is very much necessary to decide that whether a particular payment is said to be received or deemed to be received, as well as accrues or deemed to accrue or arise in India or not. Now, so far as the general receipt as well as accrual is concerned, Income Tax Act is not speaking much on this particular aspect. But however, so far as deeming fiction is concerned, a detailed explanation has been given under Section 7 as well as Section 9 of the Income Tax Act. Section 7 talks about what would be the income which would be deemed to be received in India. So it is a general understanding that whatever income a person receives in India on a general basis would be taxable in India for the particular non-resident. So I'll give you an example. If a Mr. X of United Kingdom comes to India to a factory based out of, let us say, Mumbai, and provides his technical services to that factory in India, and the company makes payment to that particular individual or particular firm of that individual, then definitely that would be treated as income received in India, or at least income accrued or arise in India, because the source of income for that particular transaction would be accruing or arising in India. Apart from that, Section 7 provides 3 transactions where, even though if the income is received outside India, it would still be deemed to be income received in India. What are those 3 transactions? So first 2 transactions are related to recognized provident fund. The annual accretion which happens to a recognized provident fund in hands of a person, as well as the transfer of funds to recognized provident fund, would always be deemed to be considered as received in India. Similarly, central government making contribution to pension of a person would be again deemed to be received in India, and as per the provisions of Income Tax Act, its chargeability has to be taken care of. Okay. I would like to definitely mention that we are going to take the question answer session at the end, but in case somebody has some queries, then we can definitely take in between. Now, Section 9 of the Income Tax Act provides a detailed list of income chargeable to tax India on a deeming fiction basis. So even if the particular income goes out of the purview of accrual or arising in India in a literal sense, Income Tax Department under Section 9 has provided a detailed list where, subject to fulfillment of conditions, that income would be treated as deemed to accrue or arise in India. Apart from that, during the course of our presentation, we would look into the provisions of Section 90, where the chargeability of income tax would be governed in consonance or in understanding with provisions of Section 90, which provides avoidance of double taxation as well as relief to a resident who is a resident of other country, and its taxability pertaining to a particular source of income which is there in India. Now, for the purpose of understanding the chargeability of tax under this Act, I would like to refer a judgment of GE India Technology Center of Supreme Court. So in this judgment, Honorable Supreme Court says that the moment there is a remittance out of India, it does not trigger Section 195. The payer is bound to deduct tax only if the sum is chargeable to tax in India, read with provisions of Section 4, 5 and Section 9. Section 195 not only covers amount which represents pure income payments, but also covers composite payments which has an element of income embedded in it. However, obligation to deduct TDS on such composite payment would be limited to the appropriate portion of income forming part of the gross. I'll give you an example. So, a person, let's continue with the example which we took just a few minutes back, that a person, just a minute. So suddenly the question flow was very high, so I was just looking at it. Uh,
Anuj, we'll take the questions at last because so many questions will be covered in your session, which is very
okay.
already in detail. And otherwise, we will be short of time. So we'll take the question and answer. I'll personally help you out to read all the questions and we'll give answers. Okay.
Fair. Okay. So now coming to the example which we were going to take. So it talks about a person has provided services in India. In provision of those services, what he has done is he has incurred certain expenditure, which he is recovering from the Indian entity. Now the question comes whether the TDS is or withholding is required on the entire sum for the purpose of his service, what he is charging, as well as for the purpose of uh, providing the service, the expenses which he has incurred during the course of provision of service, and he is simply keeping the reimbursement of the same, whether the same would also get covered in this particular provision of section 195. In my understanding, the moot aspect is that the equation of income should be embedded in the payment being made by the Indian entity to outside entity. Unless and until that income component, the chargeability component is not forming part of the particular payment, then the payment would not get covered by section 195. And while making payment, any payment outside India, one has to take into consideration that the sum has to be chargeable under the provisions of, which is what this judgment and subsequent all rulings are stating. Now let us talk about section 9 of the Income Tax Act. So they have provided a detailed list with reference to what are the incomes in the hands of a non-resident which would be considered as deemed to accrue or arise in India. So one is income from business connection in India. So what they say is that any non-resident earning its income from business connection which has got significant economic presence in India, then such income would be chargeable to tax in India. Now, significant economic presence is defined to meet with the current scenario. As you all know that our act has been enacted from 1961 and the changes are subsequently made. However, if you understand that in the doing business in certain way in the era of 1960s and in era of 2025 is significantly different. Now somebody may not have a brick or mortar office in India to do a business in India. We can all see that we can have a access to all the facilities, all the services of an entity who is practically residing outside India, and the source of such income from various users is pretty high for them. Yet, because they don't have any physical presence in India, they are not paying any taxes. So, in order to overcome such situation, the concept of significant economic presence, which is governed by the revenue threshold as well as user threshold, and it is specifically to take into consideration the digital permanent establishment in India. If some outside entity has permanent establishment in India through digital presence, then in order to curb that process, significant economic presence has been kept into. At present, what I understand is that the revenue threshold is kept at 2 crore, whereas user threshold is kept at 3 lakh users who are sourced from India and making payment to an entity situated outside India. It would make such entity to have created business connection in India, and appropriate proportion of income should be taxable in India as per provisions of section 9. While discussing section 9, I would like to just give one brief that this is a local provision and this would not only itself determine the provisions of taxability and withholding of tax. Secondly, if the business is being done through an agent who is solely or majorly working for an entity situated outside India, it would create the entity to have created business connection in India pursuant to fulfillment of condition. Secondly, the capital gain. So income from capital gain for a capital asset or property situated in India would deem to accrue or arise in India. Now, everyone or most of my participants would be aware about the judgment of Honorable Supreme Court in case of Vodafone. In that particular case, the assets of an entity situated in India was held by an entity situated outside India, and an entity from a third country acquired the shares of the foreign company one from other foreign company, and in that particular case the question of taxability had arose, that the transferor entity is mainly attaining its income or value of shares from the assets which are situated in India. Unfortunately, at that point in time, the provisions of Section 9 were not amended so as to cover this particular transaction within the ambit of taxability within India. So the judgment of Supreme Court prevailed, where it says that when the scheme doesn't provide for taxability under Section 9 of accrual or arising of an income on a deeming fiction basis, such income is not taxable in India. So what did central government did was they brought the amendment from retrospective effect from the beginning of the act. However, pursuant to the uproar, the provisions were made retrospective and subject to fulfillment of condition and to meet with the ease of doing business agenda of the government. Certain thresholds were provided, which says that if the value of asset is more than 10 crore and it forms part of more than 50% of the total assets of the Indian entity, and shares of such entity, although being held by a foreign company, are transferred outside India, still it would be deemed that this asset was situated in India, and accordingly capital gain provisions would get applied. So far as income from salary is concerned, if the services are rendered in India or paid by government of India to citizen of India, even though the services are rendered outside India, then such income would be deemed to accrue or arise. If an Indian company is paying dividend to a resident or a non-resident, for so far as resident is concerned, Section 194 is taking care of the TDS withholding. So far as non-resident is concerned, such income would be deemed to accrue or arise in India, and the TDS would be governed by the provisions of Section 195. Interest payable by a resident or non-resident for Indian business or source in India. So, so far as interest, royalty, and fees for technical services, the criteria is such that when it would be stated to be accrue or arise in India on a deeming fiction basis, first, when it is payable by a government. Second, if it is payable by a resident, but exclusion is provided that such income, if it is paid to earn business or income, it is payable by a resident, and the purpose of making such payment by a resident is to generate income outside India or generate a source of income outside India, then it would not get covered under the provisions of Section 9. Similarly, if the payment is made by a non-resident, specifically with reference to a source or with reference to an Indian business, then and then only it would get covered. If a non-resident is making payment to another non-resident, such income would not deem to accrue or arise in India if the intention is to generate business income or source of income outside India. This language is common in terms of interest, royalty, fees for technical services. So one has to take into consideration the exceptions which are provided in Section 9. I'll just give you a brief example that, for example, an Indian entity is providing certification services to entities based out of Vietnam, Japan, Cambodia, etc. Now, in order to provide such services, what they are doing is they are taking the services of local auditors. They are arranging the services of local auditors to provide services outside India. The source or the business of such Indian entities outside India, as well as the payment is being made to a person outside India, then in my understanding, it would definitely get covered by the exclusion which is provided under section 9, and the taxation would not arise if the Indian entity is able to substantiate with documentation that the source of income and the business activity are situated outside India and the payment is made to the non-resident specifically in that regard. As we were discussing in section 195 language, what are the rates in force? So the rates in force talks about the rate or rates of income tax specified in this behalf in the Finance Act of the relevant. In the beginning, when Sridhar said that the rate of tax is not provided in section 195, he was absolutely right. The definition of rates in force has been provided in section 2 of the Income Tax Act. Subsection 37A, clause 3 says that the rate which is specified in the relevant Finance Act of the year, such rate would get applicable so far as determining tax rate under section 195 of the Act. Now, one can see that if you see the Finance Act 2025 or the Finance Act which was issued immediately after the last election, there are good amount of changes which has happened in the payment to non-residents, especially the highest tax rate to be paid to a foreign company has been reduced from 40% to 35%. In the line with the reduction of capital gain tax at the rate of 12.5% in case of an immovable property from 20%, similar changes has also happened when the property is being sold by a non-resident and the tax is required to be withheld. Okay, so that is rates in force so far as the definition is concerned. That rates in force are required to be compared with the rates of income tax specified in DTAA for the specified income. This DTAA are entered by the central government pursuant to powers granted under section 90 of the Income Tax Act, and either of these rates which are more beneficial to the payer as well as the payee are to be applied for the purpose of withholding tax. Now, if you read subsection 2 of section 90, then it has been so provided that whatever is beneficial out of these rates would get applicable in the hands of payee. So one has to take into consideration that why we are supposed to look at the provisions of DTAA and why the conditions are required to be fulfilled, then subsection 2 would be helpful to a particular person in determining that the rate as per Finance Act, which are the rates in force, versus the rate prescribed under DTAA are to be compared in order to withhold the tax under section 190. Now, let us just see the procedure which we generally follow on a practical basis. So first of all, it is very much important to look at the documentation of a particular transaction and to identify the nature of transaction, whether it falls into business income, whether it is a royalty, whether it is a fixed for technical services, dividend or interest, as per the provisions of the Income Tax Act first. Then one has to see whether the sum which is being payable is chargeable to tax as per the provisions of section 4, 5 and 9 or not in the hands of non-resident. If that be the case, then one has to look at the eligibility of the person to fall within the provisions of double taxation avoidance agreement with the respective country to which the residency of the non-resident is lying with. In order to avail the benefit of DTAA, it is very much essential that the concerned non-resident provides the payer the requisite documents to justify that he is actually the resident of the respective country. Also, the benefit of DTAA may be taken in order to determine the residency of a person when there is a dual residency. of that particular person. So just to give you an example, a person who is living in India, as everybody knows that the residential status of a person is determined by provisions of Section 6 of the Act. Now, as per the provisions of Section 6, the criteria has been provided on the number of days a particular person would have stayed in India. Now, a person who has come to India and he has been residing in India, and as per the provisions of Section 6, if his residential status is resident, however, his economic and emotional and social substance is lying outside India, then the provisions of DTAA also provides for the tiebreaker rule, where it provides that what are the criteria is to be looked into in order to break the residency and decide that the person is resident of only one country. Because please, my friends, please understand that the DTAA would be applicable only when a person is a resident of one or both the states, contracting states, which are between whom the agreement of double taxation avoidance has been entered. Now, as per the provisions of Section 195(2) and 195(3) of the Income Tax Act, the onus has been given on the payer as well as payee to check whether the particular transaction is subject to lower or nil tax or not. If that be the case, then a particular person may approach the income tax department and obtain the certificate of nil TDS or lower rate of TDS. I'll just give you an example with reference to double taxation avoidance agreement. As you may all know that in certain tax treaties, there is either a scope limitation or there is a limitation in terms of the applicability of a particular transaction being chargeable to tax as per the provisions of the source country. In our case, the source country would be India. Now, I'll give you an example that in India and United Kingdom treaty, if you know, the fees for technical services is chargeable to tax in the source country only when there is a fulfillment of make available clause. We'll discuss a little bit about the same in the upcoming slides. But unless and until the condition of make available clause gets fulfilled, the firm is not chargeable to tax. Now, a resident of UK is being informed by an Indian entity that tax is being withheld under Section 195 of the Act. Now, at his discretion, he can apply within the provisions of Section 195(3) to the Income Tax Department and obtain the certificate. Similarly, the payer of the Indian entity in this given example may approach the Income Tax Department in the prescribed forms for the nil or lower TDS of the certificate. A very common transaction which I see on a regular basis for this particular low or nil TDS returns is the capital gains transactions. So as you may all know that Section 195 doesn't provide any threshold. So if a non-resident has inherited a property from his parents in India, he is living in, let us say, Australia, US or UK. He has inherited a property in India. He is selling that property to a resident in India. Now, Section 195 doesn't provide for any thresholds. So, the entire sum which is payable to that non-resident is susceptible to tax withholding. So, let us say if the property transaction has happened at 1 crore rupees, then and the rate is provided at 12.5%, then with applicability of surcharge and cess, the tax rate would come at 14 lakh. Now, if the person has some valuation report and everything available with him, he can determine the cost, and after reducing the cost, let us say the capital gain comes to only 20 lakh rupees. Under the circumstances, at the rate of 12.5%, the tax would be only 2.5 instead of 12.5 on 1 crore. In order to safeguard, it is possible for him to approach the income tax department and obtain the lower TDS certificate. If that doesn't happen, or if it happens, along with the certificate, he can meet with the payer and the payer would appropriately deduct the TDS. In case if it does not happen and the taxation goes as per the literal provisions of the Act, then the certificate of Chartered Accountant in Form 15CB would be required to be obtained by the payer before making the payment to pay. That Form 15CB would be coupled with Form 15CA Part C. There are other parts of 15CA as well, which we would discuss in the upcoming slides. So all these procedural aspects are mentioned in Rule 37BB of the Income Tax Rules. What it says, before that, earlier at the time of introduction of certification on foreign remittance, and at this point in time also, Section 195 subsection 6 says that the reporting of a transaction of foreign remittance outside India is to be made to Income Tax Department whether or not the sum is chargeable to tax in India. So please understand the scope of reporting is pretty wide. So earlier, for every transaction, whether it is subject to tax or not, in India, reporting was being made and the certifications in huge quantity were being sent to the Income Tax Department, and earlier the submissions were physical. So in order to curb that particular practice, what did the government do was they introduced Rules 37BB and they provided certain thresholds. In the threshold, what they said that when the payment is chargeable to tax, however, if the payer is of the understanding that the payment is lump sum or one time and the total payment is not going to be more than 5 lakh in a particular year, then 15CA Part A would be sufficient and CA certificate would not be required. Similarly, if the payer or the payee has obtained lower nil TDS certificate from the government itself through Income Tax Department, then also the CA certificate in Form 15CB would not be required. Only Part B of Form 15CA is required to be filled up. Part C is the only part which is coupled with Form 15CB of the CA certificate. What it says that when payment is more than 5 lakh, it is chargeable to tax, then 15CB as well as Part C of 15CA are to be captured and uploaded on the income tax portal. 15CB from the CA portal and 15CA from the entities portal. There is also Part D. It is applicable where reporting is required to be done. However, reporting is required to be done by the payer only, and no certification is required when the payer is of the understanding that the sum is not chargeable to tax. Now, if you can understand that these are two separate requirements, there is also under Sub-Rule 3 a list of 33 transactions has been provided by the Income Tax Department in consonance with the Reserve Bank of India. For such transactions, the list is forming part of subsequent slides. For such transactions, no reporting is required by the payer at the time of making payment. Part D would cover only those transactions where the exemption, specific exclusion is not been provided, as well as the sum is not chargeable to tax. So I would give you an example of a commission payment. So far as commission payment is concerned to a person resident outside India, by and large, unless and until the services are of a technical or a managerial or professional nature, that would partake the character of a business income in the hands of the service provider of commission agent. Since the person is a non-resident and the income partakes the character of a business income, that income there are likely chances that that income would not be chargeable to tax in India under the circumstances, because it may be treated that the income is not accruing or arising in India, or on a deeming basis or an actual basis. Under the circumstances, the payer is required to make necessary reporting to income tax department that, look, I have made this payment of commission to outside India. Or you can take an example of reimbursement of expense also. If the transaction is of reimbursement of expense, then one can say that, look, I have made the payment outside India. However, this payment is not subject to tax in India pursuant to the provisions of 4, 5, or 9 in the hands of the non-resident. However, for the sake of compliance, I am filing the Part D of 15 CA so that necessary report remains in your. As I have already stated, that 15 CB is coupled with Part C of 15 CA, so nothing going further on that. 15 CC is a form which is to be filed by the bankers who process your payments, who process the payments of payers, and they have to provide quarterly information to the income tax department with reference to the remittances made. In some cases, in the recent time, we have received notices in some of our clients from Form 15 CC itself. And by and large, what we have observed that Form 15 CC mainly comprises of the transactions which are not chargeable to tax in India, such as import or business income, which are not inherently taxable in India for that particular non-resident. But still, we have provided answers, and they have sailed through such. So, as I was talking about the exclusion list, this exclusion list is also forming part of Rule 37 BB. I have just taken the extract from the same. This transaction is made by a resident entity outside India and carrying this purpose code, then in my understanding, the bank is not required to ask for any forms, even if it is Form 15 CA Part D. In my understanding, it cannot be asked. So if you say for international bidding, if you are making payment, or personal gifts or donations, or remittance by non-residents toward family maintenance and savings, all such payments are in consonance with the guidelines of Reserve Bank of India, are covered under the exclusion clause. And in order to reduce the burden of compliance, these transactions should not be attached with, may not be attached with Form 15 CA of any sort. They are not as such chargeable to tax in India. However, we have seen across the banking channel that sometimes the requisition is unduly made. However, it can be attributable to the limited knowledge which may persist at the branch level. However, if you provide the necessary rules and regulations, we have seen in most of the cases that the payment is getting payment is getting processed without the requirement of 15 CA as well. Only thing is you have to softly persist that for this. Now let us discuss somewhat about the double tax avoidance agreement. So what are the double tax avoidance agreement? So central government through Ministry of Finance enters into the double taxation avoidance agreement with other country or specified territories. What is specified territories? I will just give you an example. To grant relief from double taxation, as well as to decide the allocation of taxing rights between two nations, avoid double non-taxation, and for exchange of information. So the rights are provided in the Section 19, Section 90A. Now, so far as specified territories are concerned, I will give you an example of treaty with Taipei Specified Association. What I understand is Taiwan is not being treated as a country, sovereign country, in a general basis. And in order to keep the relationship intact with our neighboring countries, India has entered into agreement not with the country but a specified territory called Taipei, and not with Taiwan. So it has got all the necessary articles with reference to double tax avoidance. However, it is a specified territory and not a country, if somebody is just wondering. what are the key aspects of a treaty? So treaty generally is forming, it's formed in terms of articles. So from the beginning till end, the different article provides the scope of resident, permanent establishment, taxability of specific incomes, and whatnot. So as I stated earlier, it also provides for the eligibility of pay to access the treaty. So unless and until the person is resident of one or more contracting state, the person would not be able to exercise the treaty. And unless the tiebreaker rule is exercised to determine from which part he has to be taken care of, from which country he has to be considered for the purpose of DTAA, the residency tiebreaker rule would be provided under the article of residency. What is the characterization of income? So, like the regular provisions of Income Tax Act, definition of specific income nature or income stream are also provided in the DTAA. So, it has also been provided, as I earlier stated in rates in force, that along with the rates which are prescribed under the Income Tax Act, rates under the articles of DTAA are required to be observed, and whatever is beneficial would be applicable on a particular payment. Now, in order to get covered under the specific article of a treaty, then it is necessary that the particular transaction should get covered by such article. So, I would give you an example of guarantee fees. Now, as you all know that the holding company would enter into agreement with the foreign lender bank for the purpose of extending loan facility to its subsidiary situated in India. In return, being a guarantor, in return, the Indian subsidiary would be paying guarantee fees to its foreign holding company. Now, if you look at the definition of interest as provided under section 2, it covers almost all types of obligations. And earlier, before the recent Supreme Court ruling in case of Johnson's Matthey was pronounced, it was treated that guarantee fees would partake character of interest so far as regular provisions of income tax are concerned, which is negated now by Johnson's Matthey. However, it is such possibility that due to limited definition provided under the respective treaty country, then such income would not partake the character of interest under the provisions of DTAA, and it would straight away either go to the business income. Now, the holding company is not in the business of business income. Then what would happen? Under the circumstances, such income would be considered for tax withholding in the residue article, being the other income article, and appropriately tax withholding has to be taken care. Apart from that, characterization of income, condition of no tax or lower tax in source country would also be provided in DTAA. I have already given you the example of make available clause. What is a make available clause? So a make available clause is that unless and until the services provided by a entity outside India is being utilized or capable of being utilized by the Indian entity in the absence of the service provider, whenever he is not available, still the services are capable of being utilized, then the said services would be stated to be made available to that Indian. Unless and until such condition is being fulfilled under certain treaties such as UK, I guess Netherlands and other such countries, the make available clause, if it is not getting fulfilled, then the loophole is available with the non-resident service provider to get exempted from the tax withholding as per the provisions of the Income Tax Act. We all saw what was business connection as per the provisions of section 9 of the Income Tax Act. Similar understanding has been given so far as permanent establishment is there in most of the articles, it is covered by Article 5 of respective treaty. In my understanding, business connection is an inclusive definition. So as to say that everything under the sun and moon would be treated as business connection unless and until specifically excluded by the provisions of Section 9. On the contrary, under DTAA, specific definitions are provided to treat a particular entity to have permanent establishment in the other contracting state. So they have been in a general parlance known as fixed place PE, agency PE, or supervision PE, and so on. Permanent establishment is very much essential in order to tax a business income in the source country. If it is established by the provisions of DTAA that the particular entity has permanent establishment in India, then to the extent of income which is chargeable to tax in India would be subjected at the highest rate of tax in India. So it is very much essential that while processing the transaction, one has to decide whether the foreign entity is having a permanent establishment or not in India. In order to do so, it is essential that the declaration that the person is not having permanent establishment in India or business connection in India is very much essential. That would very much helpful the payer in establishing at a later stage should any query arises. Apart from eligibility, characterization of income, or to reduce the tax burden, other aspects of DTAA I would say can be principal purpose test or limitation of benefit article. These are some anti-avoidance measures taken over a period of time. Principal purpose test generally talks about that if any arrangement is entered into with a principal purpose to only avoid the tax or only manage or mitigate the excess tax burden, then such transaction would be treated as not outside the purview of taxation in the source country. And principal purpose test would decide that whether the transaction was done with an intent of substance or it is only created on form basis. As you all know that across the world there are certain tax havens such as Mauritius, through which people are routing their transaction initially merely to avoid the TDS or excess tax burden. In order to curb such practices, this principal purpose test has been entered into, and this has been forming part of tax treaties post the introduction of multilateral instrument. Similarly, limitation of benefit is also an article under certain treaties which stops the third nation countries to take the advantage of beneficial provisions of treaty between two nations. So let us say a US entity is routing its transaction through a country where the terms of transaction and taxation are little bit beneficial as compared to India and US treaty. Then if under such other treaty, if such limitation of benefit article is prescribed, then it may so happen that the third nation, being US in the example, would not be able to take the benefit of treaty between India and the other country. Now, if you visit the income tax website these days, you would be able to see what is multilateral instrument. So for certain treaties, you would see the original avoidance agreement as well as synthesized text. What is a synthesized text? So synthesized text I would treat in a simple manner as a amended text of a DTAA post the ratification of multilateral instrument. What is a multilateral instrument? It is an activity which is introduced through G20 nations and OECD efforts. Base erosion and profit shifting refers to tax planning strategies that exploit gaps and mismatches in tax rule to artificially shift profit to low or no tax locations. So what used to happen was people used to do treaty shopping and avoid taxes by routing their transaction to different treaties where tax benefits were largely available. In order to curb such practice and to give proper right to a source country there fair share of tax. It used to happen that BEPS action plan were introduced, which conceived the MLI. MLI is a common document which contains the amended articles of transaction between two nations. So just give you an example, it's a common document. If the nations or those nations who have signed or who are the signatories of MLI would then enter into a negotiation for adopting the articles of MLI into their respective treaty. This step is beneficial in my understanding as against the general procedure of ratifying the tax treaty, because it is a very time consuming effort, because India has tax treaty with more than 100 countries. Now it goes on negotiating the changes in treaty as per the current norms, then it would take many years for India or the other nation to ratify all their treaties. Instead, this MLI is a common document to which more than 100 countries are signatories. Those countries then enter into individual negotiation for adopting respective article of the MLI. India is also one of the signatories to MLI. Accordingly, the treaties which are entered into by India with other countries, such can be, and the other nation, counter nation is also signatory. Let us say Sweden is a signatory, UK is a signatory, Singapore is a signatory. Then by adopting the articles of MLI, the treaty would get automatically ratified. So when you see the provisions of tax treaties, the same has to be seen post the ratification through MLI. What are the minimum standards of the MLI? I have already explained about the principal purpose test. But the other aspect is modification to preamble, which now provides avoid usage of treaty for treaty shopping and to avoid tax evasion. These are some key articles of MLI which provides additional checks and balances with reference to dividend, capital gains, and establishment of permanent establishment. These are the documentary requirement with reference to applying DTAA provisions. As you all know that in order to apply the provisions of DTAA, it is necessary that the tax residency certificate and Form 10F are given to the payer by the payee so that he can apply the beneficial rate of DTAA. This requirement has been prescribed under Section 90, subsection 4. Please note that Form 10F is to be uploaded online by the payee along with the attachment of tax residency certificate. It's a standard form. It would cover all the information in a standardized format for the payee with the income tax department. This requirement is not applicable for treaty benefit not being taken, as well as particulars of TRC containing necessary particulars as provided under Rule 21. These are the other formalities of Section 195. It says that surcharge and education cess would be applicable when the transaction is being withheld to regular provisions of Income Tax Act. Please note that in DTAA, the tax rate which has been prescribed is inclusive of surcharge and education cess and no separate chargeability is required. Grossing up. What is a grossing up? So grossing up is the arrangement which is entered into between two parties where the payee wants the payment net of taxes in its entirety. So if the service is provided for $100, he wants entire $100 even after withholding of tax, then the payer is required to bear the burden of tax and the grossing up has to happen. The rate of tax prevailing on the date when TDS is required to be deducted, not when actually deducted, as per Rule 26, one has to see. These are some other sections of Income Tax Act which provides for TDS provisions on foreign payments. Out of this specific provisions, 194 LC is, I have seen in my practice that this is very much being applicable if the Indian entity has borrowed funds from outside India and the payment is being made to a foreign bank and the borrowing agreement has been concluded before 1 July 2023, then the beneficial rate of 5% plus surcharge and cess would get applicable. In that case, I have seen in most of the treaties, the rate of TDS on interest is pretty high as compared to 5%, which is beneficially provided under Section 194 LC, which can be considered by the payer. Now, so far the TDS provisions are concerned. This is a brief list of TCS on outward remittance under LRS. As you all know that from 1st October 2023, the foreign remittance under LRS are being governed through TCS because government wants to have the control of foreign remittance outside India and for what purposes they are being made outside India. So in order to keep that practice, the provisions of TCS were introduced. Up to 31st March 2025, most of the threshold were restricted at 7 lakh and about 7 lakh. The TCS rate of 5% or 20% as the case may be were applicable. In the recent finance budget, the TCS threshold in general has been increased to 10 lakh. For the purpose of medical treatment, up to 10 lakh, no TCS has been prescribed. Above 10 lakh, 5% of TCS has been prescribed. So far as overseas tour package is concerned, up to 10 lakh, 5% TCS is there. Above 10 lakh, 20% is there. Now the clarity is not available whether once the payment goes above 10 lakhs, is it on the full amount or the partial amount, but one has to see the applicability and what I understand is on practical basis, people are taking different measures to avoid the burden of TCS, and overseas tour package providers are also taking some declarations and everything in order to avoid this additional burden in the hands of the payer. So far as education, which is funded by a financial institution, a good benefit has been provided with reference to no TCS if the funds are obtained from a financial institution which is defined under section 80. There is a typo, there is no bracket in E, there is only ET. If the education is self-funded, then up to 10 lakh there is no TCS, above 10 lakh 5% TCS is. International credit card payments are now covered within the LRS payments and TCS limits are appropriately applicable. Up to 10 lakhs, no TCS. Above 10 lakhs, yes, TCS at the rate of 20%. So these are some common issues I have identified in the time span which was given to me. So this is remitting funds to NR outside India by deducting 1% TDS under section 194 IE and not under section 195. This is a common mistake which is being made. It is essential for the payer to ensure that essential status of the payee is identified before deciding the withholding tax as well as payment. Payer to make necessary reporting compliance. So once the tax is being withheld, it is necessary that it has to be deposited with the government, and TDS return in 27Q has to be filed using TAN. So unlike individual who has purchased the property from a resident, PAN-based Form 26QB is applicable. Such is not the case for payment to non-resident, and Form 27Q after obtaining TAN is required to be filed. I have also seen that very limited applications are being made under section 195(3) or to that extent section 197 for lower TDS application. At the time of 15 CB, what happens is the documentary requirements are insufficient. Sometimes the Form 10F, which is required to be uploaded online, is not obtained from the payee, and only a manual copy is made available. I have seen in the past that even the payee who is required to file return of income in India and make necessary compliance cannot avail the benefit of DTAA in the ITR because they have not filed Form 10F online, which is compulsory. Sometimes the payments which are of a very small and minuscule amount, as they say a subscription or a services which are of, let us say, $500, the director of the company would say that I would pay from my card because I would get some points in benefit in return. What happens is that the said payment would get automatically out of the purview of tax withholding by the company, because in company does the reimbursement to the director, and ultimately the transaction gets avoided from tax withholding. Please note that the payment to alternative means is not the idea through which the tax can be avoided, and one has to ensure that the necessary compliance happens in such case also. And are not applying PAN in India. Please note that subject to the exceptions which are provided under Rule 37 BC and 206 AA subsection 7, the non-resident is required to apply for PAN in India, and in some cases it is also required to file return of income in India. If that be the case, it is necessary that he makes all the compliance in India, and so that no subsequent inquiry and anything can be covered to them. So far in the limited time, I'm sure I'm still within some time to answer the questions of my August hearing.
Yes.
Yes, so we can do so.
First of all, thank you so much, Anuj, for this
Yes.
wonderful presentation. We are full of question answers, and there is a lot of curiosity in the participants to ask. And first of all, I would like to compliment from my side for this wonderful, energized presentation. I think many questions have been resolved, and many have arrived from our participants from their practical experience. And we are friends here, all set to resolve your queries. We will
Yes.
try our best to attend as many queries as possible. और अगर कुछ कम रह जाए तो please contact Anuj ji personally. ठीक है?
Please.
So
I
let's.
would suggest through Sridhar, you may all please share your queries, and I would definitely try to resolve the same in the upcoming time for sure.
Yes.
And thank you for
And
giving me an
about the
opportunity.
PPT part, Anuj, please share it. It will be shared through Gyan Station community. So you
Certainly,
can join the.
I'll share with Dipti ji, and then she can place on the portal accordingly. Yeah.
So community link is in the chat. So please join the community so that you can get it. And
Fair.
Anuj, now I would like to take the questions that which are in question.
Sridhar ji, I would like one question to be taken by Mr. Suresh Ameria ji. He had several parts of that question. So can I take with your permission? Or you can please take that question by Mr. Suresh Ameria ji from, you please go through that. I was just going through Q&A. And sir, if you can please unmute yourself to ask that question, it will be great help for all of us.
So what was the name of the gentleman? Sorry.
Suresh Ameria.
Yes.
So the question is with respect to section 9. If you can read, Anuj, you can directly give answer.
Yes. With respect to section 9, if royalty or FTS is paid by resident to non-resident company outside India for generating income to Indian resident from outside India, whether the same is taxable in India and withholding tax to be done, I have actually answered, because there is one exclusion which is provided in the section itself, 916 as well as 917 specifies that where the business is outside India as well as source of income is outside India, then one can argue that the income is not taxable in India in the hands of the non-resident, and that's why benefit of the such exclusion can be taken along with necessary documentation. There are recent rulings of even Chennai Tribunal as well as Panji Tribunal on this particular aspect is there.
But in this case, income is to resident, Indian resident.
I have asked you to unmute the sir himself. Sir, welcome here. And sir, please would like to hear also a few words from your side for today's presentation and session. Over to you, sir.
Dipti, you're talking me, no?
Yes, sir. Yes. Sir, you are audible.
Yeah, it was a great presentation by Anuj, and really I love this. Is I think first time, Dipti, I have joined Gyan Station. The topics were so interesting, and even for the tomorrow's topic, it is very interesting regarding non-resident, and I really enjoyed, and I have Anuj has clarified many queries, and I have posted some queries on chat, this question and answer box. So Anuj will clarify all this, and really it was a great, I mean, we updated our knowledge. A lot of queries got resolved. Thank you so much, Dipti, and panelist and speaker Anuj and Mr. What is his name? Sridhar ji. Thank you so much.
So, Suresh ji, the query which has been posted on the chat box, it talks about the payment made by a resident to a non-resident outside India for generating income to Indian resident from outside India. So, what I understand is the payment is being made by a resident Indian to a non-resident company, and the services are services are provided by the non-resident company outside India, then the income earner would be the such non-resident company. The income earner would be not the Indian resident from outside.
Listen, hello.
Yes, sir.
Can you hear me?
Yes, definitely.
See that UK-based company is providing services like research, financial research, market research services to an Indian company. In turn, that research data which that UK company is providing, that Indian company is using that research and sending its final report to their clients abroad, like in US, UAE and all. This Indian company raises invoice to USA and UAE company, whereas the UK company which do research for Indian company raises invoice to Indian company. So my query was regarding in that context.
Understood. So in this case, what would happen that the source for the Indian company, which is using the report of UK company for providing the services to people who are situated in USA, would be the income source outside India, as I understand your query correctly. Then under the circumstances, what I understand, what I think is that the exclusion would trigger and accordingly it would not be taxable.
Okay, got it.
Thank you.
So
Thank you so
so
much.
this thing was the source from the point of view of payer we have to look, or from the
Yes.
point of view of pay.
Yes, from the payer one has to see, because the payer is a resident.
Okay.
So if the payer is a resident, then so far as the UK entity who is doing the prima facie research, that income would not be chargeable to tax in India for that UK entity.
Okay.
Got it.
Thank you so much, sir. We can move ahead. Shridaji, please take. Thank you so much, Suresh sir, for your feedback, and hope this query is resolved. And
Anuj will read it and answer it. It will
Sure,
be
sure. What
make
is the
the
next query?
things quick.
From the top, I am taking right now.
Yeah,
Okay.
take it from top.
Sure. So Mr. P. Srinivasan Rao has raised that my son is sending money to repay his education loan taken jointly and send money from us to repay loan to my account, and I pay same to the financial institution. It is any tax problem in this case? Sir, what I understand is you are receiving funds from your son to make the payment to an Indian institution. So according to me, there is no foreign remittance being forming part of the whole transaction. And in all situation, I am just reading whatever is there on the chat box. And please pardon me if I don't understand your query. You may always write to Sridharji and I will try and answer it separately. Is TDS applicable? Amul ji has raised that is TDS applicable in case of merchant trade in software. Say software is purchased from Singapore and supplied directly to a client in USA. Are we required to deduct TDS on Singapore company? The software is an off-the-shelf software and no customization is done. What I understand, Amulji, is that post the Supreme Court ruling of engineering analysis, this question is by and large resolved, because the issue of copyright and copyrighted article is stated in very much detail. It is more than 200 pages judgment. Request you to look at it. It at least it summaries. In my understanding, this would not be. If the income is not taxable in India, there is remittance of exempt income. What are implications? If income is not taxable in India, it is out of the purview, Mr. Ganesh, and it would not be chargeable. Indian pharma company remitting to various countries, government medical department. See, the word is government medical department. So what I understand is there are, I think, ruling of Gujarat High Court also on this particular aspect, which says that payment to any statutory authority outside India may not get covered under any of the provisions, and it is not considered as income in the hands of the respective government department, and accordingly tax may not arise. Arunji has written a very good long query. An Indian company making foreign remittance to USA on account of testing fees of their product. Indian company received TRC Form 10F and non-PE certificate. Taking advantage of make available clause, the company treats the resident remittance as business income and deducts no TDS. Now, if the payee avails benefit of DTAA, then 115AA, the payee is liable to file ITR. If the payee do not file ITR, whether the Indian company is liable to pay any tax liability? See, practically, income tax department may ask the Indian entity, because the foreign entity is not in their command coverage as well, and it's route for them to take any tax withholding from them. However, you can substantiate your payment by 15 CB certificate and all the documents which you have stated. Plus, if any query arises, I see that some litigation may arise and some consultant services has to be. Dividend payment to foreign shareholders, taxes and documents required from Indian company for the same need information. Sir, it's a very long answer. In my understanding, 15 CA should get applicable, and the withholding as per local provisions, Finance Act is, in my understanding, 20%. You have to see the DTAA and obtain necessary.
So, Sridharji, can we do something like this? Jo people who are asking long queries, as we are already time bound by 6:30, and we already have many queries to go ahead.
We
What we can
we
do?
extend it for 5 minutes, and thereafter, if there are queries, the same can be posted to you, Deepti ji,
Okay.
right?
So
And
for
we'll
the
try
queries,
we'll
what
try
I'll
to
do,
answer it.
Sridharji, what I'll do, I'll share one group link to take those queries which are not taken here. So I'll just take all those queries together and share with Anuj ji to get resolved.
Yes,
Yes.
definitely.
So please continue, Anuj ji.
Yeah, Anuj,
जितना
we
होता
will
है
take
उतना
5 minutes.
करते हैं
Yeah,
हम
5
लोग,
minutes
try
we'll take,
maximum.
and there, yeah.
Understood. So, Ganesh ji in his second query has asked reimbursement of expense, no TDS, Ganesh ji. NNOMA certainty is there. Hello, if individual based out of India and doing trading in Indian stock market from his personal and company demat account, what is the chargeability? The chargeability is income is received in India, then appropriate reporting in the ITR has to be done and tax as per slab rate has to be paid. Or if since the transactions are through stock market, appropriate tax rate applicable to non-resident would apply. Please the finance. Suresh Ameria, I have already answered the query of sir. Kantilal ji, for rates which Finance Act to be considered, at the time of making payment, the Finance Act which is prevalent has to be. In case of benefit of DTAA is not taken, whether TRC mandatory, DTAA benefit not taken, then for your documentation requirement, please obtain TRC so that at future reference, if somebody says that this person, whether he is a tax resident of foreign country or not, you may always keep the documents handy. If NRI has bank account in Indian, payment is made in Indian account in INR, whether TDS, sir, another bank account of self is not covered by it. Vishal Surti ji, the company with 95% of export turnover is paying fees to a resident of another country. So PAN available and hardly visits the company, but the turnover is not the criteria for determining the tax withholding. Is paying consultancy fees to person resident to another country. Sir, the country, you have to see the DTAA, obtain the TRC Form 10F and no P certificate. You can then see whether the beneficial rate or make available clause is available in the respective country and accordingly decide the course of action. As per the regular provisions of the Act, it is taxable at the rate of 20. TDS on purchase of property 12.5% or 20%. If the seller is non-resident from 23 July 2024, the rate of long-term capital gain is 12.5%. Even if payment is made in rupees to a NR for purchase of property, yes, it would be. If lower deduction 97 or whether 15 CB required or not, 15 CB is not required because you would be filing Part B of 15C and not Part C. With reference to the anomaly of banks, I have already answered that you have to softly push because ultimately if agitation is made, you are at the loss because your transaction would get deep. SEP shall constitute business area means transaction and goods as a deducted payment of import. So, sir, from Finance Act 2025, significant changes have been made in reference to this significant economic presence. Request you to refer to the same in case of further queries are there. Definitely answer. Charmium, whether 15 CP applicable in case of acquisition, maybe no. Separate forms are there. Suresh, sir, can you explain with example concept of make available clause? I have already given one example. In case further clarity is required, we can join personally with a specific. Kamal Parekh ji, what are the consequences of TDS is lower rate than actually required in the sir? You would be responsible for all the requisite prosecution or the penalty under the provisions of TDS for less withholding or no withholding. I think should we stop here?
Yes. It seems we will have to take another session rather than going with all correct questions. Anuj, you are not audible.
Saying that path is also raised during the course of discussion is had, I guess. So if I have, if he has some queries, I would definitely like to answer that.
Okay. So
Yeah.
we'll be ending the session now. I request all the participants to share their feedback in the chat box. It will definitely boost our morale, and it is the actual vitamin. I will say it's vitamin that keep us on toe and to bring more and more such webinars with such subjects here. So please share your valuable feedback in the chat box. There were so many questions which could not be answered. There were so many questions which were covered during this session. So YouTube recording is available. Anyone can go through it and definitely get few answers. Otherwise, you can connect to Anuj. The PPT will be shared. It will be having details of Anuj too. So over to you, Dipti ji.
Thank you. 1 minute. I'll just say it's a superb, great presentation, and what an excellent response we got for today's topic, today's speaker, and wonderful, very interactive participation from all the members. And it's really overwhelming. The session is really so much overwhelming ki, as Sridhar ji rightly said, ki it's the vitamin for organizers. Participants' feedback is the vitamin for us to continue the good work which we are doing. It keeps us motivated to come up with better webinars, better topics, because as the motto is Jnanam Paramam Balam, the knowledge is the most empowering thing in this world. With knowledge, we can be the Vishwa Guru, or it's a humble effort, a small effort on behalf of Gyan Station, ITPA, Choice Group, and AGFTC, GSTBA and TAG, कि हम थोड़ा सा उसमें कंट्रीब्यूट करें हमारे देश के लिए कि भारत विश्व गुरु बन सके. सो ये जो कोशिश है, this mission and vision is this only, कि we could impart knowledge to our professionals, and they यहाँ से जो भी वो लेके जाते हैं, it can help in Indian economy either by financial service knowledge, financial sector, or tax, or anything it could be. So it will help us to strengthen our economy, Indian economy. तो ये कोशिश है. और again we are coming up tomorrow with an interesting topic which was again designed by our own Sridhar ji. तो श्रीधर जी उसके बारे में ब्रीफ करेंगे. मैं मीनवाइल मैं ऐसा करती हूँ कि आई विल जस्ट शेयर द चैट बॉक्स में the link for tomorrow's webinar so that you can immediately register. Sridhar ji, please brief about tomorrow's topic.
Yes.
Yeah.
So tomorrow's topic is about taxation of non-residents individuals, and we will cover the very basics of residential status to DTAA and all these things, and what incomes are taxable in India, what incomes are not taxable in India on basis of the residential status, and all the questions related to that. We will also cover the NRO and NRE account and foreign currency accounts part also, where people are having basic confusions. So the session is designed for very basic understanding, but very important understanding, because at the time of filing ITR, we never ask for the passport and check whether the person is non-resident or resident. That is the very basic step. And we'll go with the very basic step in tomorrow's session. Again, as a president of ITBA, it would be the last session I would be conducting. Thereafter, I'll be stepping down as president, and new president will take the chair. So tomorrow is the last session, and I'm very excited, and that is going to be taken by our past president, Advocate Kartikeya Shah. He's also PhD in international taxation. So I wish that everyone will join the session and be benefited. And I asked Kartik ji especially to cover few questions that people can ask. So be ready with your questions too. Thank you.
Thank you so much. So please join us tomorrow. And I think Parth has also shared something in the chat box. So with respect to any queries, please connect with Parth also. Yeah, thank you. Parth,
Thank
would
you.
you like to say something?
Yeah, actually,